Good afternoon and welcome everybody. Welcome to Perpetual Pip. It's time to get started here with yet another week's worth of broadcasting and hopefully aggressive opportunities. So to that end, let's go ahead and let's begin with a little AV check. If you'd be so kind, in the box, please go ahead and indicate whether or not you can hear the sound of my voice. We'll go ahead and we will begin immediately here with our infinite search of opportunity. It looks like on my end, I'm doing a quick check here just to verify, the AV does seem to be functioning. So there they are, perfect. AV confirmations are coming on in. Thank you, Mr. Gordon. Thank you, Sean. I appreciate that. Excellent, Leo. Thank you very much. I appreciate that. Samir, thank you, my friend. Awesome. Okay, perfect. So let's go ahead. Let's begin. Good morning, everybody. Good evening, good afternoon, whatever the case may be. Welcome to all here at Perpetual Pip. Let's go ahead and let's get started. We're going to do so, of course, with the customary AV check, which we've done, and of course the disclaimer. As you guys know, I am not a commodities trading advisor. So effectively that boils down to I can't tell you when to get in, can't tell you when to get out, right? Definitely cannot do that. I will not plan trades for any one trader in particular. Instead, what I'm doing is I'm taking a look at the markets. I'm looking to seize opportunity as the opportunity presents itself, right? But I'm trading my personal account. We're all big boys and girls, and so we're all trading our own accounts. I don't expect that you jump into a position just because I think that it's the right thing for me to do. It definitely has to be something that you agree with, something that's easy for you to understand, easy for you to execute, easy for you to obey. I can teach you how to do all these things, at least the first two, but I definitely can't do the third one for you. Right? I can't execute it for you. We're all trading our own accounts. So it's got to be something that you, once you've compared to your own analysis, if you agree with it and you think it's a good idea, then by all means, but it's got to be your decision. Right? Why do I bang on about this? It's mainly because there is inherent risk in what we're doing, right? In any kind of exchange, on any one of the exchanges, no matter what investment vehicle you've chosen, be it currency, cryptocurrency, stocks, options, commodities, it doesn't matter, right? It really doesn't matter. There is inherent risk in what it is that we're doing here. Some traders exceed their initial investment in risk, right? And certainly that's not what we're looking to do at any point in time. So I want to make sure that we're following appropriate equity management criteria. If you need any help on that, any pointers as far as making sure that you're not overexposing yourself at any point in time, don't hesitate to let me know. Just feel free to let me know. Look, Will, what kind of equity do you follow? I'll be more than happy to show you what it is that I put into practice with my account. I do so on a daily basis. But again, you should also definitely sit down with your financial planner and discuss that kind of thing, that topic directly with a financial planner, a certified financial planner as well, just to make sure that you are doing everything as best as possible, right? And your local bank should be able to provide you with at least a consultation on that, whatever bank you currently have an account with, if not your broker as well, okay? So just want to make sure that I put that information out there for everyone for the benefit of all the traders in the room. Definitely want to make sure that we're doing everything with our financial growth in mind. With that said, let's go ahead, let's get started. A new week and it's time for another dollar. So we're going to begin by taking a look at the fundamental calendars. I like to be aware of what's getting ready to take place here throughout the course of the day, specifically what's going to be taking place during the course of our time together, right? I certainly want to make sure that if there's anything fundamental or any fundamentally charged sections that we are preparing for it, or at the very least know that it's getting ready to take place. So if we find ourselves involved in any positions, we can manage the positions accordingly or be ready to participate with any fundamental events. That doesn't appear to be the case at this point, at least according to this calendar. I'm going to be looking at several calendars to cross-reference. But according to this calendar, from the looks of it, it would appear that there are no major projected impact announcements getting ready to take place from what I can see. All right. I see here that during the U.S. session, the U.S. is having new home sales be released today. So we might see a little bit of movement for the U.S. dollar, but this is taking place at around 10 a.m. Eastern time. Now, that's not to say, by the way, the Federal Open Market Committee is also going to be having some speeches. This is not to say that the new home sales announcement will not have an impact on the dollar, right? It is expected to be major projected impact according to this calendar, and I don't want to downplay its importance. However, I will be unable to set up with you guys on this because it's so far out. If it were, it's kind of out of my jurisdiction, if you will. So since the announcement is so far out, I won't be setting up for that here together with you guys. But if there are any traders in the room that require any clarification on that, please feel free to let me know that in the box. It would be my pleasure to explain that to you. All right? It would be my pleasure, my privilege. Don't hesitate to let me know. I'll be more than happy to work with you and get you up to speed as far as how you can potentially look to tackle this. Between these announcements, I've got to say that I would expect that these speeches taking place from the Federal Open Market Committee should be a bigger deal, but these speeches are not until the 26th. Today is the 25th. So these are going to be taking place tomorrow, Tuesday the 26th. That's when you should start to see this play out. All right, moving right along, because according to this calendar, there's nothing that we need to be setting up for. We've got some German announcements which could possibly impact the value of the euro, but they're not expected to be high projected impact according to this calendar. So since they're not expected to be high impact, I won't be looking to set up for these. Let's move on to the next calendar, though. The next calendar is the one from forexfactory.com. According to forexfactory.com, we pretty much have the same confirmation here. The euro is putting out several announcements. This business climate survey that they like to put out is taking place, but this one is not expected to be high impact. We're looking at medium impact at best. So because it's only expected to be a medium projected impact announcement, it's not something that I'm going to be looking to set up for. All right. Beyond that, the U.S. announcement, new home sales is not expected to be a big deal according to this calendar as well. Well, actually, according to this calendar, I should say, because the last one did expect it to be a big deal. And then we have an announcement here for Japan. But again, low projected impact. So since it's low projected impact, I'm not going to be looking to devote too much attention to it. All right. So let's go ahead. Let's move on to the next calendar. Next calendar is investing.com. Just kind of going through the motions here, making sure that we can get to confirmation. This calendar, investing.com, does expect that this German IFO Business Climate Index is going to be a major projected impact. Now we're expecting 2.2, 2.2, 1.7. All right, we're expecting about 1.7% change here for this calendar, and they're expecting it to, for this index, they're expecting it to decrease, evidently. But the last two calendars that we've taken a look at have not really had major expectations here for this event. So I would prefer to be prepared for an opportunity, and I'd rather not have an opportunity and have it pass me by than not be prepared. But I do still want to cross-reference with the rest of the calendars and see what the expectation is here for this announcement taking place at 4 a.m. Moving along, let's take a look. dailyfx.com. Shift this to Eastern time. According to dailyfx.com, yeah, they are not really expecting anything major here out of this. Best case scenario, it looks like they're expecting medium projected impact. So far, 3 out of the 4 calendars we've looked at are not expecting anything major. And last but not least, if we look at fxstreet.com, fxstreet.com seems to be indicating that medium projected impact as well for that euro survey. So even the U.S. announcements, according to this, I'm not seeing the Federal Open Market Committee announcements being released here, but new home sales for the U.S. is expected to be between low to medium impact on these sites. So for the most part, the majority of these calendars are expecting very low volatility here as a result of these announcements. Only one calendar is expecting the Euro Business Confidence Survey to be a major issue. So why don't I put this up to a vote? If there are any traders in the room that are interested in preparing for a fundamental breakout, all right, please feel free to indicate that in the box. All right, if you have any desire to set up for that, just feel free to make that known in the box. I've got an overwhelming majority of calendars that are not expecting a major projected impact event. But I am willing to set up for it if there are any interested parties in the room. Okay, otherwise, we'll simply transition right on over to the charts and start looking for some aggressive opportunity. I'm going to start off by taking a look at long-term direction for the euros and long-term direction for the pound crosses. If there's anything building up, then fantastic. I can look to tackle the markets in that direction and especially look for entries in that same direction using the Pip Snapper tool. Okay. So far in the box, I'm not seeing any traders that are expressing any interest in setting up for that possible euro aggressive entry. So let's go right ahead then. Let's transition right on over to the charts and let's start knocking out some currencies. Taking a look at the first currency that we're going to take a look at is, let's see here. We'll start off, we'll do these in alphabetical order. I'm going to start off with the Euro Aussie. Okay, Euro Aussie. For the Euro Australian dollar on the daily time frame, we're currently looking at a capital bullish AB boundary. Capital A is at price point 1.5081 and the capital B is at price point 1.5817. So we've got a deep sea retracement here. The market has expanded pretty aggressively in the bullish direction after providing this deep sea. However, after such an aggressive extension, it looks like the market might be a little overdue for a pullback. And indeed, it looks like it is trying to get to the right side of an aggressive trend line here, a micro trend line as I like to call them. All right. Now, as far as this micro trend line is concerned, in all fairness, I will say that although this is a bearish decision candlestick formation getting to the right side of this micro trend line, I don't really have the U-turn that I'm looking for here in the bearish direction. It looks like it's underway, and the market's definitely starting to make some progress in the bearish direction. But I don't have as much of a U-turn as I would like. I like that this is beginning its flow, but I don't have as much of a U-turn as I would prefer. It's still very, very much at its infancy. So what can I prepare to do here? I can start to prepare for the impending opportunity, but I don't think it's quite there yet. Let's see if we can get some additional convergence across multiple time frames, maybe for something a little bit long term. Here on the 2-hour time frame, we are looking at a capital bullish AB boundary as well. Capital A at price point 1.5155 and the capital B at price point 1.5797. Now we've got a deep sea retracement here. We're talking about a 618, actually it's a 786, so the projected D extension target long term should be the 1.27. But again, as we discussed on the larger time frame, this market already has expressed a bit of a desire, right, to start making its way in the bearish direction. So this is that longer term counter trend line that we looked at from the larger time frame. The market made its initial press in the direction of the bears and has been pulling back here. If this is what I think it is, which it is giving signals of a potential head and shoulders here, then that means that the right shoulder is starting to form here. So if we've got left shoulder here, this is the head, break of the neckline was over here. If you missed that break of the neckline, that's okay, because if you're on the outside looking in, you could simply be paying attention for the next aggressive or micro trend line break here to the right with a bearish decision candlestick formation to be your trigger. I've got to say I'm a little disappointed with the current location of the stock RSI. I would really prefer to have the stochastic indicator in the overbought zone. If that stock RSI entered into the overbought zone and lined up with a larger time frame, then I would feel a lot more comfortable about looking for an entry in the direction of the bears. Right? Bearish decision candlestick formation, breaking this aggressive line, stochastic indicator U-turning downward as well. If you take a look at the last series of stochastic U-turns with a bearish candle, we had some pretty decent dips in the bearish direction. Right? Here's the last stock RSI with a bearish candlestick formation. The market fell. This on the 2-hour time frame, very conservative, about 60 pips. This last one here with the stochastic indicator, bearish candlestick formation, this fell conservatively about 88 pips, right? There's the overturn here. This was about 130 pips, right? And so on and so on. You can see that when the stochastic indicator U-turns along with a bearish candle and a break of an aggressive trend line, if I drew these in, you would see multiple opportunities. These are all opportunities to be able to participate in the bearish direction. Break there. Here's a U-turn, right, with the break. This is a failed one, right? Don't want to not mention that. This is a failed opportunity. But here's another aggressive break with that U-turn to the south. Here's that other one that we talked about, right? Bearish candlestick formation, so the subsequent dip. here as well. So all in all, when these formations are forming, we're seeing some sort of movement in the direction of the bears. That's what I'm expecting is getting ready to take place here next. For traders that require a little bit more structure, I had sub down ABCDs in the direction of the bears, but I've gotten rid of those here because we had a bit of a reversal, right? The market, that when the market found that deep sea retracement, started making its push in the direction of the bulls, those sub down ABCDs were taken out. Now, if I'm on the outside right now and I require the additional structure of a retracement sub ABCD for a nice conservative target, then what I can do is, again, follow the rules of drawing Fibonacci retracements. Start at the new, quote, highest high and go down to the very first low. This is going to be my very first Fibonacci right here in this new sequence. And if this is my C retracement, we're looking at approximately a 5-0. So the projected D target would be right here from where we currently are to the 1.618 projected D extension target. We'd be looking at right in line with the previous moves in that direction, about 80 pips or so toward fulfilling that D extension target. Right. So from the outside looking in, I've got to say the stochastic indicator does leave a little bit to be desired. I really would prefer to have that stochastic indicator making its U-turn. And I really would also prefer to have a bearish decision candlestick formation, because right now the current candle is indecision, right? It is an indecisive candle. I really would prefer to have mostly body breaking to the right side of this line. I can't really allow that to break since it is an indecision candle. So I really would prefer to have a nice bearish decision candlestick formation breaking to the south, but that's not really what's taking place here. So since it's not what's taking place, I can't talk myself into a position that's there. Perhaps later on, if the market managed to break something, I can review, right? Maybe possibly place an alert. Let me go to my alarms and make sure I delete all this starting with a new week, right? So I can, if I needed, add an alert on this line. If the market manages to cross down below this counter trend line, I can come back, take a look at it and see where we stand as far as an entry is concerned, or even better still, the stochastic indicator U-turning to the south, looking for that opportunity. This has already given me a false, right, a false alert. So let me just go ahead and add the alert here to the stochastic indicator. If this crosses down from the 80% line, I want to know about it. Right, it's going to require it to go up and then come back down. Then it will give me a longer term signal. Now, if I'm looking to be extremely aggressive about this, quickly here, I also don't want to ignore that there seems to be a little sideways action as well. Okay, I'm going to remove these lines. I don't want this to get super busy. All right, so I'm just going to leave the one that's currently relevant. All right, and I don't want to ignore this range that seems to be forming here also. So this range may form a bit of an issue for some traders. Okay, I'm going to clone this line. Right, and if we're just talking about the nearest level of support, never mind the Fibonacci, right, from where we currently are to the average of support that this market seems to be hitting, we're looking at a consolidation range that's about 55 pips. So that's close, but not exactly what I would personally consider a medium range. Right, the stock RSI is in favor, but this is technically forming a bit of a smaller range here, less than ideal. So there's a few things that I can't really say that I like about this at the moment. The fact that it's inside of a small range is one of them, and the fact that it isn't really providing any kind of solid candlestick formations. I also can't get the stochastic indicator in the overbought zone. So maybe if this kind of reaches up a little higher and I can adjust my resistance for this range, I might be in a different boat. If I can get at least 60 pips between these 2 points, between resistance and support, then I'm going to be looking a little better or a little bit more favorably upon this. But I'm not really seeing that being the case at the moment. So unfortunately, I'm going to have to pass on this right here, right now. Aggressive traders, Right? Aggressive traders may feel a little differently about this, right? This is in the sell zone. Right now it's in the midst of retracing, and it has called for an entry as far as the pip snapper is concerned. This may very well give the entry in the direction of the bears, and you can look to try to participate with this just for the duration of the session aggressively. For me personally, since the distance between where it currently is right now is less than 60 pips, I am going to go ahead and I'm going to choose to pass on this at the moment. This will possibly be to my chagrin, right? But I am going to go ahead, I'm going to follow the rules, follow my own rules, and I'm going to go ahead, I'm going to have to pass on this at the moment, especially considering the European session isn't even open just yet. All right. Any questions on the pound? Excuse me. We did not look at the pound Aussie. We looked at the euro Aussie. Any questions on this before we move on to the next currency? Next currency that we're looking at. Consolidation so much tighter here, and the market did break out rather aggressively, I've got to say. Right now it's just pulling back, and overall larger time frames seem to be indicating that this is getting ready for an extension. So for you aggressive traders, you guys that are really looking for an entry opportunity, if you can get a bounce off the trend line with another bearish candle, because technically I missed that. So if you can get a test of the line, I will understand if you choose to enter into that. Okay, let's move on then to the next currency. I'm going to save this. We'll move on to the next currency on the list. Next currency on the list is the Euro Canadian. I'm just going to open the rest of these up as well. Let's take a look at the Euro Yen, and we're going to be looking at the Euro Kiwi here as well, hopefully before we transition to the next section, before we take our first break. So we've got a capital AB boundary here for the Euro Canadian. Capital A is at price point 1.4442, and the capital B is at price point 1.5571. So this market also, much like the last currency pair that we saw, has been making its way in the bearish direction, lower lows, lower highs. We broke the inner trend line, and here we've come back above the inner trend line. I've been tracking the bearish move with the sub down ABCDs, and right now, as far as the sub is concerned, this market has given a very deep C retracement of the 618, maybe even a 786. Let's verify. Oh yeah, 786 at, oh yeah, it's a 786. So if that's going to be the case, that means the projected D extension target here for the sub would have to be the 1.27. So the market would have to be going down here either to retest the current C or go toward a deeper C retracement if it planned on fulfilling that. Based on where we currently are, the fact that the market has tested that line, has been unable to penetrate it, we're seeing really long wicks to the north. I would expect that this is going to break, that this aggressive extension line, this micro trend line, is going to break, and the bears will start to force this market down. Now, whether or not they're able to fulfill that sub A, B, C, D, I can't really say is going to be my chief concern. Instead, I'm looking for something slightly more conservative, because I do believe that the next wave is going to be in the direction of the bears. But instead of looking to go for that home run, instead, I'm going to think about possible problem areas that this market may encounter. So the first problem area that this market may encounter is the trend line itself, and the trend line is about 200 plus pips away from where we currently are. Right? If we're talking laterally, right, that's on the conservative side, the trend line itself is over 200 pips. Then the actual very first level of support from where we currently are, well, that's going on 380 pips. So that's even more opportunity. And lastly, if we go toward this C area, 580, toward the actual D extension target, about 615, maybe 620 pips, thereabouts from where we currently are. So we are certainly looking at a lot of opportunity here on the horizon for potential short. The only thing that I don't see is the actual entry signal. I don't see any kind of appropriate entry signal that I can look to participate here with this on the retracement. On the 2-hour time frame, let's see if we can get convergence across multiple time frames. The 2-hour time frame has given me a capital bearish AB boundary, capital A at price point 1.5714, and the capital B at price point 1.5208. So we've got a deep C retracement here. Based on that deep C, we are looking at a 50618. Sub up A, B, C, D has been fulfilled. Because the sub up A, B, C, D right, because this up A, B, C, D has been fulfilled, we would then be able to draw a new sub up AB boundary, right? And with the new sub up AB boundary, the sub C retracement, or sub ABCD retracement, we can see that this most recent sub AB boundary has a super shallow retracement. Because we have a super shallow, what this market should want to do is come down toward a deeper C, and it's going to have to move in the bearish direction in order to be able to achieve that. So all I'm waiting for then would be the actual bearish entry signal, a bearish decision candlestick formation getting to the right side, the stochastic indicator also lining up, U-turning downward for the highest percentage chance that that's actually going to succeed and take place. But we also have to be realists, right? This is an expectation of what the market will do. We have to be realists and understand, number one, we're not seeing convergence across multiple time frames. And number two, if we take a really close look at what this market's been up to for the last 6 to 8 hours, we see lots of indecision, right? We see a very, very small, very indecisive range here on this, right? And since we have such a small, indecisive range, an astute or an educated trader is not really going to be looking to be a participant in any kind of range where the market is way too sideways, right? Where the market is way too erratic. Total distance between the average of support to the average of resistance that we're looking at is only about 8 pips. So because we're looking at about 8 pips worth of consolidation here, this is not a range that I really want to be a participant with. I'm going to link this across the rest of my, I don't want to do that. Okay, I'm going to sync this to my smaller time frame so I can see it as well. And then we can go ahead and we can actually take a look at this on the smaller time frame. Here is the 2-hour time frame. For the 2-hour time frame, actually it looks way better on the 2-hour time frame. We can clearly see that tiny consolidation range. Capital AB boundary, A at price point 1.5714, B at price point 1.5208. The market has given me a retracement up here, nice and deep, 618. So the projected D extension target long term should be the 1.618 over time, if that's what the market plans on doing. But from where we currently are, from where I'm currently sitting, despite the small because of the small consolidation range, the lack of convergence with the larger time frame, this is not quite overbought. This leaves quite a bit to be expected. So since this is not meeting the criteria that I generally look for, I am going to have to go ahead and pass on this one as well. This market is stuck inside of a very small consolidation range. That's not the environment that I want to consider here for a trade whatsoever. So I'm going to go ahead and I'm going to have to say that this is going to be a pass for this euro at the moment. As long as it remains within that, it's not something I want to be a part of. All right, last but not least, the 10-minute time frame. If you're using the pip snapper, we are seeing the back of the bounce at the backside of the trend line. This may very well be what causes the market to break out of that range. But unless I see the breakout, I'm going to have to wait patiently for that to take place. Right? If you're looking to be very, very aggressive, it looks like with the European market about to open, this market seems very interested in heading in the bearish direction. Those of you that might be considering that. I'd understand why. If you're looking to just aggressively scalp and trade the pip snapper, by all means. It has indicated an entry, dipped in the bearish direction, pulled back, tested the trend line, and here it is once again taking off in the bearish direction. If you would rather wait for the market to give you a lower low or something along those lines, again, that's also reasonable. Right, the market has just, though, given an evening star. This is another bearish candlestick formation at a test of the trend line. So, and with 3 out of the 3 lines in the sell zone, technically, this is calling for an entry in the bearish direction. All right. So for those of you, do I expect that this market's going to be going bearish? Yes. Absolutely, Rico. Yes. If I'm going to look to enter in, what I'm looking for is more of a position type trade. And if I'm going to get that, the market's going to have to break out of that small range. I would just prefer that to be the case. Make sense? Any questions on that? All right. So let's go ahead then. Let's move on with this information established. I'm just going to take a quick note. Same situation here. I will indicate. But I'm going to go ahead and pass. Wait on this to create lower low. All of them seem to be getting ready for an aggressive push in the bearish direction. The larger time frames seem to be in agreement. And this would be the most aggressive entry. So it really does have me kind of teeter-tottering as far as, am I looking to trade the position, a longer-term position, or am I looking to trade aggressively for the session? And because of how aggressively they're moving, it really does have me second-guessing and just looking to trade the aggressiveness for the session. If I'm just going to adhere to the perpetual pip snapper for the duration of this session, then I would have to accept that this market... stop doing that, please. There we go. Select that. Let's see where, if I chose to enter in, my main concern is that the stop loss may be too tight right now. So if I chose to enter in, this did manage to give me a slightly lower low. I don't really like the stochastic indicator where it is. But this is providing me with a lower low. If I place my entry at this point, my stop loss would be up at 0.6. So risk coordinates 30 pips in risk from where we currently are right now would put my stop loss up here. My larger time frame doesn't seem to be in agreement with this, and that I really don't like. That's really holding me back. So I'll tell you what, I'm not going to get swept up in the emotion here of what we're looking at. Let's not do that. I'm going to remain steadfast on this. I'm going to go ahead, I'm going to choose to pass on this. All right, I'm opting to pass on this. Let's take a look at the euro yen. I think that we'll have enough time to take a look at the euro yen and identify what may be getting ready to take place. For the euro yen on the daily time frame, we're currently looking at a capital bullish AB boundary, A at 122.40 and B at 134.41. B nice and high, only exceeded a few times. Deep C retracement, projected D target of the 1.27 based on this 786 retracement. And we've got a few conflicting signals in all fairness here on this currency pair. Right? There's a few conflicting signals. This market broke out of the consolidation range going bearish. It did manage to create a slightly lower low. But then now we're in the oversold zone. So this is divergent from the rest of the euro crosses that we've looked at so far. This is at support, and it's at support of a range. Here's the new range. And from where we currently are, if we measure from support to resistance, the range itself is about 60 pips in size. So because it is about 60 pips in size, it is technically a large enough consolidation range that I can consider for aggressive entry. But the aggressive entry would have to be in the direction of the bulls because we're at support. And the larger time frame that seems to be expecting this market is going to be taken over by bullish momentum. So that's one thing that we have going on here. 2-hour time frame also seems to be indicating the same thing. The 2-hour time frame has the stochastic indicator in the oversold zone. So because the stochastic indicator here is in the oversold zone, and this also seems to be getting ready to make a push in the bullish direction, I would have to say that the euro yen, as opposed to the rest of the euro crosses, is showing convergence across multiple time frames, except it's divergent with the rest of the basket. Now that's okay, because each one of these currencies kind of has its own personality and is allowed to do what it wants. But at the moment, I can't really say that I see an appropriate entry. I would have to have some sort of decision candlestick formation, which lets me know that it's okay to participate. And at the moment, the market hasn't really formed a decision candlestick formation just yet. Right? It's close. Right? And if I get a bullish decision candlestick formation at support of the consolidation range, closing inside that range, I could look to participate very short term, trying to take the move all the way up to resistance. But I have to do so on a much smaller time frame, which would allow me to react very quickly. So here's what this looks like on the 10-minute time frame. On the 10-minute time frame, I'm slightly below the average of support here. This market's going to have to. Right now, it is forming a nice bullish candlestick formation. But so far, that bullish candle is not A, in the buy zone, which means it has to get above the red and black lines, and B, it's not yet inside the consolidation range. So effectively, what I want to see in order to consider an entry buying this is for the market to form a bullish decision candlestick formation closing inside that range, for it to be beyond or to the right side of the red and black lines, indicating that it is in the buy zone. And 3, I want to see 2 out of the 3 entry lines actually enter into the buy zone as well before I will consider this for a buy. Right? At the moment, the market is not forming that signal, so I'm going to hold on this, but I am going to take a note that I am looking for a bit of a buy here on the euro yen. Okay, so let me... Okay, I'm taking that note right now, putting that in the box. Right, I didn't like that the larger time frames are showing me divergence, so I opted not to trade those. This one is showing me convergence, but it's not quite yet giving me the appropriate entry. All right, I don't see any questions on the box for the euro yen. So let's move on then to the next currency pair here. We have the euro kiwi. This has been saved. I can close that down. Euro yen. We've discussed this thoroughly. Gonna compress this. I can't seem to compress that anymore. All right, so this should be, no, it hasn't saved yet. Usually it saves pretty quickly, but all right, we've got that. Last but not least, let's take a quick peek at the euro kiwi. And the euro kiwi seems to be lining up with everything else. Euro kiwi, we've got a capital A at price point 1.5995, B at price point 1.7215, deep C pullback of the 5.0, projected D target long-term 1.618 at resistance. Sub AB boundary has managed to give a 5.0, and so this is starting to show its desire to U-turn and go in the bearish direction. But so far, we're lacking the market actually forming a decision candlestick formation, closing to the right of this aggressive micro trend line. We're not seeing the actual stochastic indicator U-turning to the south. So because these things are not happening, I'm a bit hesitant to jump into a position just yet. On the 2-hour time frame, 2-hour time frame is showing us that the recent market behavior is creating a bit of a medium range, right? Capital bearish, AB boundary A at price point 1.7062, B at price point 1.6704. Now on this time frame, since we are a little bit more visible from the perspective of the medium consolidation range, the market is forming a bit of a bearish candle. Stochastic indicators also U-turning down to the south. It looks like this may very well be the beginning of a potential entry opportunity on a much smaller time frame to be able to try to participate with the run towards support. From where we currently are towards support of this range, it looks like there might yet be another 40 pips or so left of opportunity. That is enough. Since the range is at least 60 pips in size, that would be enough for me to be able to lock in some profit on the way down. And if the larger time frame is going to have its way, well, it may cause this market to break out of this range completely. Right? And if we manage to break out of that range completely, we're going to be able to maintain the position, continue to ride it on down toward a lower low, maybe even to the D extension if the market decides it's going to move aggressively in that direction. Right? This is a counter trend line. I'll go ahead and color that in purple. All right, but the momentum seems to be in agreement here. So for the Euro Kiwi, let's take a look. The Euro Kiwi at this moment right now is providing me with an entry opportunity with the pip snapper to be able to short. The only possible issue that I have here is where's my stop loss going to be? Stop loss from where we are, looks like it's going to be at 0.1, so 1.6901 it looks like. Coordinates 901. That is acceptable, so I will go ahead. I will take this entry short for the Euro Kiwi. The European session is open, I should say. So I will go ahead and I will take this as an entry right now. For the Euro Kiwi, I will enter in with a short. Stop loss 30 pips, and as long as the market does not change bias, I will look to maintain this position for as long as the market offers me the opportunity. Right, so I am in this short. I will look to place targets at plus 20 and plus 40 pips, entry price 6866 thereabouts. So first target down to 46, right, plus 20 pips, and the next one after that would be at 26. This one's going to get an alert. All right, plus 20, plus 40. Okay, so we'll see how this continues to evolve as time progresses. With that said, let's go ahead, let's move on. We have come pretty much to the break time for this first segment. I have opted to go for a short here, so this is just an FXCM chart, so it doesn't show it. All right, so I've opted to go for the short here. Hopefully I'll be riding this for some time, maybe even to the end of the session. Who knows? That'd be really nice. And we'll certainly see. Let's go ahead. Actually, we've still got some time, which is nice. Let's go and take a look at the first pound cross. All right, and I believe that I am going to continue taking a look at these during the course of the break, that way taking any opportunity that may present itself as early as possible. I don't want to miss out on any opportunities, and some of these pound crosses are moving pretty aggressively. Let's start off by taking a look at the pound Aussie. For the pound Aussie on the daily time frame, we are currently looking at a capital bullish AB boundary, A at price point 1.6163, B at price point 1.7909. This market right here, right now, after testing the B high of resistance, seems to be forming a bearish candlestick formation or about to break this micro trend line. Stochastic indicator also in the oversold zone. So it looks like we do have some potential building up here to be able to short. On the 2-hour time frame, I have to say that I dislike this, okay? I don't have convergence across the board indicating that I have an entry to be able to short. The stock RSI is showing that this market finds itself in the oversold zone, is actually U-turning to the north. So this could just be an aggressive move to retest this nearby level of support before making yet another pullback, followed by an aggressive dip down even lower to the south. Now, in all fairness, I have to admit that this market right here, right now, is moving kind of aggressively in the bearish direction. The stochastic indicator could realistically dip down into the oversold zone and remain flat as the market continues to press down in the bearish direction. We have had a pullback, a test, and this is the bounce off to the south. All of these things are true, but that's not how I do business. I would like to have as much convergence as possible. I really would prefer to have the stochastic indicator up here in the overbought zone rather than jumping in based off the emotion that I'm starting to see a big candle. Okay, so I am going to choose to pass on this. This is not giving me the necessary convergence that I would prefer to see across the board. Okay, the last thing that I want is to get in as this market finishes its move to retest this level, and then on multiple time frames. Here's the 2 hour, here's the 10-minute. Get in pretty much right when the market's getting ready to start to pull back. That's not what I want to be a participant with. Yes, it would be a shame to miss out on any aggressive move that the market makes, but again, I don't like to deal based off of just hoping and emotion, right? I want to see convergence, as much convergence as possible. All right, any questions on this? Okay. Let's go ahead then. We're going to take a short break. When we come back from the break, we're going to continue working here with the rest of these pound crosses. I'm going to go ahead and move on to take a look at the the pound CAD. We'll move on to the pound Aussie. We just took a look at the pound Aussie, I should say. We're going to take a look at the pound CAD, pound yen, and pound Kiwi when we get back, searching for more and more opportunity. Right now, I've got to say the Pip Snapper is indicating that these are set for a short. So for those of you that are just looking to scalp, just looking to take Pip Snapper trades, I've got to say the market is moving in that direction at the moment. Things look pretty good. The momentum seems to be in favor of that. So just because I'm choosing not to trade it does not mean that you have to hold off. Feel free to make an educated decision for yourself as a trader whether or not you want to participate. All right. With that said, let's take our first break. I'm going to put up the 15-minute timer. We'll come back once that timer counts down to 0, and we'll continue taking a look at additional currencies as well as currency requests, any currency that you feel comfortable discussing in the box when we get back. This has been Will Gomez, FX Showtime. See you soon. Welcome back, everybody. Welcome back to Perpetual Pip. It's time to continue here. We're looking at several different currencies in the last segment. We're going to continue doing more of that. The next currency here on the list, looking for aggressive opportunity. Next currency on the list is going to be for the Great British Pound Canadian Dollar. So taking a quick peek at the pound CAD. Pound CAD on the daily time frame, we're looking at a capital bearish AB. A at price point 1.6759, B at 1.8716. Now, much like a lot of the pound and even euro currencies that we've looked at so far, this is gearing up for a bit of a U-turn, or appears like it's gearing up for a bit of a U-turn, another push in the bearish direction. Unfortunately, though, we don't yet have a solid enough candle to justify jumping into a sell at this point. Right? We would have to have the market provide us with some sort of actual bearish decision candlestick formation crossing to the right side of this micro trend line. Right? The stochastic indicator actually U-turning to the south. It's in the right location to begin that U-turn, but it just isn't giving us the U-turn just yet. So it would be a little bit premature to look to jump into a position at this point, at this juncture. Going down to the smaller time frame currently is giving us a capital bearish, actually, we have to adjust. Why? Because the capital AB boundary in the bearish direction has actually been taken out. The retracement has been large enough to cause this market to actually reverse and have a bullish AB boundary now. What I was tracking sub ABCD retracements now have to be now have to be relabeled as the capital bullish AB boundary for this market on this time frame. Right? I am also removing the trend lines since the trend lines were broken. All right, we have a brand new trend line that needs to be drawn across all the lows of support. That's weird. All right, trend line, outer trend line like so. and inner trend line. Right, and you can even, if need be, draw a micro trend line there. I'm going to leave that alone for now. Let's label the AB boundary capital A at price point 1.7259. 1.7259 for the capital A. Okay, capital B at price point 1.7651. 7651. And we've got a C retracement here that is super shallow, less than a 382. So the projected D extension target long term should be the 1.618. We've seen the U-turn here, the break of the aggressive inner trend line. The only thing that we don't have since then is the stochastic indicators converging. Right? Larger time frame is not indicating that that the market is oversold. It's indicating that the market is overbought. So that's why I'm looking, or I would like to see an entry opportunity in the bearish direction. The problem is the smaller time frame is not supporting that. This 2-hour chart is not in support of that. We have the possibility of this market coming up here first, or at least coming to retest this level of resistance first before it's ready for that dip. So from the outside looking in, I believe that I'm better off waiting for this market to come up here, retest resistance, for that to fail, and then look for an entry opportunity at that point when the market manages to give me some sort of sell candlestick formation up here. The fact that it's failed to do that so far leaves me out. So I'm going to go ahead and I'm going to pass for now on this currency. I didn't move this to where it should be. I'm going to pass on this for now because I don't have convergence across multiple time frames. I realize that some of the candles, or the momentum of some of the candles shown, was pretty aggressive with the beginning of the segment, but we can see here the momentum pulling back, right? That momentum came out aggressively bullish at first, but right now we can see the market pulling back here on these. So I am going to wait patiently for the market to let me know that it's ready before looking to participate with any kind of entry. Any questions on this so far? Everybody feel comfortable with what we've discussed? Okay. Moving right along. Next currency on the list. I'm going to take note of this actually. I want to take note of so far what we've seen. We looked at the pound Aussie. I can't get convergence there, so this is a pass. Okay, so I decided to pass on this one. The pound Canadian. Actually, what I'm waiting for really for now is for these to come up to the larger time, to test the trend line. So actually, let me put that, it's a little bit more descriptive really. Okay, wait for larger time frame. TL test. Right, the larger time frame comes up to that point of resistance and tests, then I can once again look for entry. But right now we're seeing a lot of retracement action going on a lot of these. So it's actually better for these markets to come back up. If I'm on the outside looking in, it's actually better for these markets to come back up and test this and give me the entry that I really want to see. That way I'm selling the market at a much higher price, and I've got more opportunity on the way down, especially if I can get some convergence, which I don't have at the moment, and that's a problem. All right, so same thing for the pound CAD. Okay, let's go ahead, let's move on now to the next currency. Next currency is going to be the pound yen. We'll take a look at that. I have a few currency requests in the chat box to take care of as well, so we'll certainly handle that in a moment. Great British Pound, Japanese Yen. Let's jump to that. For the Great British Pound, Japanese Yen, on the daily time frame, this, much like the Euro Yen, is a little divergent to the rest of these. Okay, capital A is at price point 160.09, and the capital B is at 124.79. We have the market, after giving us a deep sea retracement, moving in the bearish direction. Overall, we are seeing the market generally complying with the overall downtrend, making lower lows, lower highs. But since we haven't come down to give a deeper C, the trend line is where it is. So if we take note of what the market's done recently, we see a break of a medium consolidation range with a bearish candlestick formation. The market's come back up here to retest resistance, and based on that, I would be expecting that the market is going to continue doing what it's doing, moving in the bearish direction and pushing toward a lower low. The only thing is that the stochastic indicator is, as near as makes no difference, oversold. So this is very, very unusual. I can't get convergence here for the pound yen because the signals seem to be indicating that the market's in control of the bears, but the fact that the market's hesitating near the same average level of support, it's failed to create a lower low. It hasn't given me a solid bearish decision candlestick formation closing to the right side yet, to the right side of this aggressive retracement line. So we've got a lot of things that are kind of up in the air with this currency, just like the Euro Yen. It's not exactly fitting the mold like the rest that we've looked at so far. So a little bit of a uncomfortable situation with respect to the Euro Yen. On the 2-hour time frame, 2-hour time frame is showing convergence here, that this market's potentially getting ready to rally, right? Stochastic indicator also in the oversold zone, showing that this market may get ready to pull back. So despite the fact that we've got a capital bearish AB boundary, A at price point 1.5385, B at 145.95, this market's come up here to give us a deep sea retracement. Projected D extension target should be the 1.618, but it looks like the recent move that it's made has been enough for this time frame. It looks like it might actually be tired of moving in the bearish direction. So for the duration of this session, we might have this market retracing or pulling back in the bullish direction here short term. From where we currently are to the nearest point that could interfere with the market moving bullish, we've got the B low here, and that's over 100 pips from where we currently are. Over 100 pips from where we currently are of potential bullish movement. If I'm on the outside looking in, then I want to be aware of that for the duration of the session. This may be what's getting ready to take place, but I won't look to participate without an actual buy signal, which the fact of the matter is that I don't have. Right, the yens appear to be depreciating, and as the yen depreciates, we will be looking to buy what it's being traded against. So in this case, the pound. Right, euro showed pretty much the same thing. If we take a look at the 2-hour time frame, 10-minute chart rather, the 10-minute time frame seems to be showing signs of getting ready to turn around and potentially go up bullish short term. So perhaps if this shows me something that I can work with, I can look to participate with an entry short term, trying to participate bullish or trying to take advantage of the contrarian opportunity. But I'm doing so with the full knowledge that it's going to be for a very limited amount of time, and I need to be ready to get out of that position just as soon as, if I get involved with the pip snapper, just as soon as the pip snapper says get out, I've got to be out of that sucker, right? And managing as aggressively as possible. So I'm going to go over here to this workspace, and for the pound yen, I'm also going to put wait for buy. Okay, if I get a buy opportunity, I'm going to look for the buy opportunity for the yen. The rest of these, I'm waiting for a test. Okay, larger time frames are showing the desire to want, but I don't have convergence on the larger time frame. Any questions on this so far? We're going to take a look at the pound kiwi next, and then we'll start taking a look at some of the currency requests that were made in the box. Any questions on the pound yen, though, before we move on? All right, let's move right along. Next currency request. Well, actually, next currency on the list here from the aggressive currencies that I look to participate with is going to be the pound kiwi. For the pound kiwi, daily time frame, we currently have divergence, is what we have. Okay, capital A at price point 2.2002, B at price point 1.8627. The pound kiwi has given us a deep sea retracement. Actually, no, this is still right around the 382. The projected D extension target long term should be the 1.618. Stochastic indicator starting to U-turn in the bearish direction, so we should be seeing the potential opportunity to be able to short here for this currency pair. But so far, we do not yet have a break of the aggressive counter trend line. We don't have a bearish decision candlestick formation providing the entry. We don't have the stochastic U-turn in our favor. So since these things are missing, I am currently on the fence with respect to looking for an entry. We have that nice candlestick formation that did recently, excuse me, I went to the 2-hour time frame mistakenly. Daily time frame shows that the market came here to pass support which acted as resistance, and the market seems to be rejecting that. So more than likely this is going to be manifesting as an actual U-turn on a smaller time frame. But as far as something that's actionable for me at the moment, I can't really say that I see that right here. All right, so let's go down to the smaller time frame and see if we see any kind of convergence at this point. Smaller time frame for the pound kiwi. Great British Pound, New Zealand dollar. We have also a capital bullish AB boundary. Capital A is at price point 1.8903, B at price point 1.9643. Got a deep sea retracement of the 8.6 with a projected D extension target long term of the 1.18. Here, after the market gave us this deep sea retracement and started to push in the direction of the trend overall, we see that the market came to this past level of support which acted as resistance and held, forced the market back down. So the signals are there that this market is potentially on the way to give us a slightly deeper point, but the fact is that most recently I don't have any reason to look to be able to participate with continued shorting. Why? Because I have divergence across multiple time frames. The larger time frame is showing one thing while the smaller time frame is showing another. And because that is the case, that's not the kind of environment that I feel comfortable trading in. We did see a lot of momentum in the bearish direction, especially at the start of this, but at the moment, we're seeing also the stochastic indicators are not quite in alignment. We're seeing long wicks to the south of these candles, and long wicks to the south are indicative of the bulls seriously pushing back. So it would be better if I can get a decision body candlestick formation, closing decisively beyond that, and the stochastic indicator in the overbought zone U-turning down to the south before I felt most comfortable looking to enter into a position here short. Any questions on the pound kiwi? Any questions on the pound kiwi? Just trying to avoid being suckered in to any situation where my larger time frame is completely at odds with what I'm seeing here with the aggressive market momentum of the session. I'm generally trying to avoid that situation if I can help it. Okay. So now that we're in the clear as far as these are concerned, we've taken a thorough look at every single one of them. Let me go back here to this, and I'm going to also take note on this that I'm waiting for I'm waiting for convergence from the larger time frame for that more aggressive short opportunity. All right. So that is that as far as the aggressive currencies that I'm looking to participate with. So far, only the one that showed the convergence across multiple time frames seems to be making some decisive movement in the direction of the trend. It is making some pretty decent progress, and that's okay. The rest of them can't seem to really continue to push aggressively. They've moved initially with the open of the session, but they're all hovering by their own independent level of support, which doesn't seem to be the case for the Euro Kiwi. So that's okay. That's kind of what I like to see. All right. Let's go ahead. Let's move into some of these currency requests. The first currency request that's in the list is for the US dollar, Canadian dollar. So we'll go ahead and we'll look at that together, my friend. Last week, we looked at a pretty unique situation with all the US dollar crosses kind of finally giving way to that opportunity for dollar weakness short term. So we can continue to expand on that. If you want to take a look, Jesus, since you want to take a look at the at a dollar cross, would you be opposed to taking a look at the US dollar index first? It's my tendency to always take a look at the dollar index first, just so that I can get my bearings as far as that's concerned. And then once I have kind of direction from the US dollar index, what the expectations are, then I go ahead and I start to consider what kind of entry I want to take on the rest of the dollar crosses. All right, perfect. So let's take a look at that together. Let's transition over to the dollar index, and then we'll take a look at the US dollar Canadian. And by the way, this goes for everyone. It's an open invitation. If you have any currencies that you would like to discuss, feel free to type those into the box. It'd be my pleasure to take a look at that with you. Here's a dollar index, and it looks like it has been making some pretty significant progress in the bearish direction, but it looks like that move is also coming to an end very soon. We have a capital bullish AB boundary for the FXCM Dow Jones US dollar index. Capital A is at price point 11,564 with 21, and B at price point 11,916 with 63. So we've got a super shallow C retracement here, way less than the 5.0. So the projected D extension target long term should be the 1.618. Now, considering what we're looking at right here, last week we talked about the potential when this market was creating this high and overbought. We were talking about the potential for a short-term reversal here for the dollar. That's exactly what's taken place. The dollar has been dipping. So far we've dipped from the height that this market created down to where we currently are right now. We've fallen upwards of 89, almost 90 points. So with the dollar index, when you're taking a look at the dollar index, you're taking a look at an estimated value of what the dollar is worth. They do this by considering the average values of the 4 major world economies that compete with the dollar. You have the Japanese yen, you have the euro, you have the Australian dollar, and you have the pound sterling. Okay? Unlike the rest of the dollar indices, like the trade-weighted US dollar index or the USDX, right? Which kind of works off of GDP and other factors. Because of the fact that these other two indices kind of give more weight always to the euro takes up the lion's share of strength in these indices. We're talking about 51%, give or take, on any one of these other two indices. And then you also have very, very small percentages for developing nations, et cetera, et cetera. So if you want to compare oranges to oranges, what the US dollar index, the FXCM Dow Jones that we're looking at right here, I think this does a better comparison to other developed industrial nations as far as value. So you take the aggregate of those 4 major competitors to the US dollar and you use them to figure out the average value of the dollar. I think this index does that very well. And so what you have then is For every point that the US dollar moves, you can expect at least 2 pips on your dollar cross. We established we're looking at about 90 points worth of movement here for the dollar index. So if we've got about 90 points of movement for the dollar index, you can expect about 180 pips on your typical US dollar cross so far. Now, we also can see that the U-turn is nearing completion, right? So far, sorry about that. So far, this market has moved 67% of its overall capacity. We're at 41, actually we're around 43. So about 67% of its movement has already been expended. The momentum is there's very little momentum left for this market to continue pressing bearish. So what we have here, if we take a critical view of points that might impact the dollar negatively, then what we have to accept is we're coming really, really close. We're coming dangerously close to the trend line. So for those of you that may have also joined in with me for dollar weakness entries, if you haven't already, you should be looking to manage your position, right? I would be looking to manage my position if I still had any open. I closed them out late last week. If I was still involved with this, though, I would say that best case scenario, this market is going to make it to test the trend line, maybe a bounce of this past level of support that could act as resistance. But as of right now, it's retesting this past peak that could act as support, right? So we're looking at maybe another 25 points or 50 pips on your average dollar cross for the rest of these currencies. Maybe we're looking, if we're optimistic about this, maybe we have that much left. This is in no way, shape, or form a guarantee. This market may definitely be getting ready to wrap up sooner than that. So from an optimistic perspective, I would say tread very carefully with the dollar. As a matter of fact, from the outside looking in, what I'm preparing for now is for the dollar strength opportunity. I would expect at the trend line, I'm going to start looking for the market to give me some sort of reaction, some sort of bounce for dollar strength at the trend line, with this stochastic indicator in the oversold zone starting to U-turn to the north, and look for an opportunity to be able to buy dollar strength, maybe even the fulfillment of this A, B, C, D. From the trend line, or from the current price, if you will, toward the actual D extension, we're going to be looking at about 110 points. 110 points transitions over to about 220 pips. So that would be a pretty significant amount of potential opportunity that I can look to participate with. All right, any questions on this? Okay, let's transition, take a look at the rest of the time frames. The 2-hour time frame actually is already oversold. Right now, this is divergence, and I don't really like divergence between the time frames. We are right now for the 2-hour time frame at the trend line and oversold. So it seems like this may be getting ready for an early spike in the bullish direction. All right, from the outside looking in, though, if we are extremely critical, if we're hypercritical of this market, I've got to say that we are showing more signs of slowing down and less signs of any actual movement here. So that's okay. If the market continues sideways, that's all right. We're looking at a range here of only about, measure the distance between support to resistance, we're only looking at about 10 points here. As long as the market's within something like that, I don't really want to be a part of it anyway. But expect that once this market comes firmly to the trend line and possibly forms a bullish candlestick formation at that trend line, starts to U-turn to the north, particularly if both the larger time frame and the smaller time frame are in agreement, then start to expect the value of the US to start to come up here, especially after it breaks out of this small range. All right, I'm no longer looking for continued dollar weakness. I'm looking for dollar strength. All right, we are a little divergent here on the 10-minute time frame. If you're looking for something aggressive, those of you that are outside of the US, you might be looking for, those of you that are outside of the US and do have the ability to trade the dollar index, you might consider something like this as a potential entry. If you're not outside of the United States, then you flat out are not allowed to trade this. You cannot trade the FXCM Dow Jones US Dollar Index. All right. In either case, considering the divergence that I'm seeing here, the fact that the market right now remains inside this very small range, two, that it is at support technically in the buy zone, but the stochastic indicator is divergent in the overbought zone aiming down. This generally is not really a nice type of combination of signals. So again, I would really prefer to have this market leave this range, if at all possible, remaining in the buy zone, kind of coming up here, breaking out of this small range for me to feel most comfortable with my next entry, possibly looking to participate with dollar strength. Any questions on the FXCM Dow Jones Dollar Index? All right, nice and clear. Perfect. So let's move on then. Next currency on the list. Oh, Jesus. Yeah, well, exactly. It's the dollar index, like I said, it's a reflection of the value of the dollar. So they take all those other currencies that we talked about, the pound sterling, the euro, the Japanese yen, and the Australian dollar, right? These currencies from developed nations. They add them all together essentially, and they divide them by 4. 25% weighted average for each one, as opposed to like the other indices where the euro is usually over 50% in weight. So that's the first thing that they do. Because of that, if you take a look at this, and you can do it on another chart, actually, I'll go ahead and I'll do this right now. Just open up a separate, I'll open a new layout, right? And I'm gonna just do a bunch of daily time frames, right? I can open up to 8 charts. The free version of this won't allow you to do this. You can only view one chart at a time. So that is a little bit of a drawback, but I want you to see what it is that I'm talking about. So this is the US dollar. This literally represents the value of the dollar. Now, if I have, let me name this right now so I know what it is. Okay, rename. This is going to be USD daily comparison. Okay, I'm going to go through and I'm going to add US dollar charts here to this. All right, so we're going to go Aussie US dollar. This is going to be the Euro US dollar. Actually, no, it should be Aussie CAT Euro US dollar. This will be the pound US dollar, GBP USD. This is going to be the Kiwi US dollar. This is going to be the US dollar Swiss franc. Actually, this should be the US dollar Canadian dollar, US dollar CAD, US dollar Swiss franc. And we have the US dollar Japanese yen. All right. So what you're going to notice is a pretty distinct phenomenon. All right, I'm just going to get rid of this so there's no confusion. Remove this. Remove that. All right, so it's just the candles. All you have to take a look at is the candles. Now you see this for the dollar. See this from May to June, this movement from May to where we are right now, July, right? Now look at this. This is the Aussie US dollar. Look at what the Aussie did. As the dollar was going up here, you see how this is going down? Right? You see it? This is another one. Here's the euro. Dollar is going up, euro going down. Dollar going up, pound going down. Dollar going up, Kiwi going down. See it? Let me compress this just a little bit. All right, you can see it. See it? Peak to peak, stretch to stretch. I'm going to compress this here. See it? That's what's going on here. This represents the average value of the US dollar, right? And so although if you're a US citizen, you're not allowed to trade this because it's an index, and flat out you can't trade the US dollar. If you're a US citizen, regulation prevents you from trading the US dollar index. You can't trade it. Can't trade it at all, right? If you could, let's say you lived outside of the US, even if you are a US citizen, but if you lived outside of the US like I do and you have a international account, then you would be allowed to trade this. If you did choose to trade this, you would be able to the way that this is traded is that everything is increased by a factor of 10. So if you chose to trade this, you're trading if you're trading a micro lot, you're trading like if you were trading a mini lot. If you're trading a mini lot on the dollar index, it's like you're trading a standard lot. If you choose to trade a standard lot on the dollar index, it's like you're trading 10 standard lots, right? In both pay and if you lose, right? Of course, that goes positive and negative. So effectively, the way that you can look at this, the easiest way that I can describe this, see it? Here's a dollar-based currency. See it? Right? Whenever the dollar is rallying, you can see these currencies that also have the US dollar listed first will be rallying as well. Right? This represents the value of the dollar. This represents the value of the dollar in relation to this. Right? It's always, when you take a look at a currency pair, it's always going to be the first currency, that's the base currency, followed by the quote currency, right? The secondary currency. So whenever you're looking at a chart, your candles quite literally represent the value of that first one, the base currency, right? And so you're always comparing for every one of these, how many of these, the secondary, will you get? So it stands to reason then that when you're looking at a chart like this is called a dollar base chart. The US dollar is listed first, right? So here's dollar base, dollar base, dollar base. These represent the value of the dollar in relation to whatever the secondary currency is. It stands to reason then that if this represents the value of the dollar and this represents the value of the dollar, they should reflect each other. Right? You should be seeing more or less the same thing. And that's exactly what we're seeing. See it? Now these are being traded against the dollar. This represents the value of the Aussie in relation to the dollar. This represents the value of the euro in relation to the dollar. This represents the value of the pound in relation to the dollar. This represents the value of the Kiwi in relation to the dollar. So since we're looking at these other currencies' values and not the dollar, it stands to reason that as the dollar rallies, these would dip, 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 dip. Okay? When you are looking at the dollar index, you use that as the baseline, and then you can pretty much make an educated decision across this entire basket on all your dollar crosses. Make sense? I think it really, really helps to see them laid out like this, because you can clearly see the dollar as compared to everything else. If it has the dollar listed first, like this, then it should be following the US dollar index. If it has the US dollar listed second, it should be doing the opposite of the US dollar. So if you ever hear me say if you hear me say dollar strength, right, that means that I see that the dollar is going up, which is what it's doing right now. And I'm looking for a dollar strength opportunity. If I say I'm trading dollar strength, then that means that I'm looking to sell these and buy these. If I look at the US dollar and I see that the value of the US dollar is falling, like it was last week, then I will be looking to enter into a US dollar weakness opportunity. So If I am looking to trade US dollar weakness, then that means that I'm looking to buy these and I'm looking to sell these. Makes sense? Usually I get into this in more detail during my non-farm payrolls lesson, right? Next week, if I'm not mistaken, because to my knowledge it is next week. Let's take a quick peek together. Let's go to forexfactory.com. Nope, that's not forexfactory.com. This is all right. With this website visible, let's look at more. All right, let's go all the way down to Friday. Friday is still June. Okay, good. So they cannot. All right, perfect. So it is going to be next week, right? Next week is going to be non-farm payrolls and the unemployment situation for the dollar. In preparation for that announcement, I usually discuss market cornerstones, support and resistance, understanding and reading candlestick formations. We talk about consolidation, support and resistance, and how to trade consolidation, the different types of consolidation. We talk about appropriate equity management techniques. And then on Friday, leading up to the actual announcement, I will do a lesson that encompasses all the subtleties that I think are important. There's a pretty big spread here as far as trader skill levels and platforms. So what I try to do is I try to do a general discussion that will help traders to be able to optimize the options that their platform provides them with, right? I give a baseline that you will be able to use no matter what platform you have. And then I kind of get into some of the additional options that I'm aware of that certain platforms offer and do not to be able to deal with potential drawbacks that you might end up with. So Friday, I'm not necessarily, the Friday of the announcements, it's going to be, we conclude before, the announcement is the first Friday of every month, 8:30 a.m. Eastern time. That Friday, a few hours before we're working together, I usually try to get into all of those subtleties and just make sure that I teach everything so that it's fresh in your mind when non-farm payrolls actually presents itself, right? Last non-farm payrolls was a big disappointment. Unfortunately, there wasn't a big breakout, but that doesn't matter. It is historically a massive announcement. It's usually a very, very big deal. And the numbers for the U.S. Last month weren't that bad. Numbers for the U.S. The first announcement, non-farm payrolls wasn't that great, but unemployment wasn't that great, but non-farm payrolls was excellent, and the average hourly earnings was also not too bad. So we've got, we'll see what ends up actually taking place. I don't want to forecast anything because I don't really know. No one knows until they actually release those numbers. When they release those numbers at 8:30 a.m. that morning, Bureau of Labor Statistics will release it, and then we'll see whether or not the market's going to react to them. But yeah, that's pretty much what I'm doing. So I think that it really helps to be able to be aware of what effect to expect when it comes to your dollar cross. Does that make sense? I didn't mean to go completely overboard there, and if I did, I apologize. Sometimes I do that. Hopefully I didn't overload anybody with this information, but I figured that showing it this way, you can actually see it in action. As the dollar does what it does, the average value of the dollar, you can see this effect on the rest of the dollar crosses, and you can make decisions effectively based off of it. All right? So I would encourage you to be aware of this, or at the very least take a look at it. And this is why I usually will take a peek at the FXCM Dow Jones US dollar before taking a look at any dollar currency requests. All right. So again, based on where we are, based on the analysis, the US dollar looks like it's getting ready to test the trend line. And since it's just about at the trend line, I'm expecting that it's going to bounce off the trend line and start to make its move once again in the direction of dollar strength. So if it is going to start to strengthen, then I'm going to be looking for opportunities to buy dollar-based currencies and sell dollar quotes. But first things first, I want to see it moving out of that really tiny little range, which is not exactly attractive at all. Right, and that goes back to the rules that I tend to follow. If any consolidation range is less than 60 pips, then I consider it to be a no trade zone. So the consolidation range that we looked at very recently, it was about 20 points, which would still be less than the number 60, right? But if we're expecting about 2 pips for every point that the US dollar index moves, then we're looking at maybe a 40-point range on your normal dollar crosses of sideways consolidation, which is something that I don't want to be a part of. So I just choose to pass. All right? You are very, very welcome. You're very, very welcome. All right, so let me go ahead and let's move on. Let's actually take a look at the currency that you wanted to take a look at. I apologize for going on like that, but it sounds like the information did you some good, so not a problem, my friend. Let's move on and take a look at the US dollar, Canadian dollar. Are you living in Canada, my friend? Jesus? Oh, okay, that makes sense. All right, that makes sense. Cool. So another thing that you might want to be paying attention to is whenever the U.S. puts out crude oil inventories. Right? Crude oil inventories does have a tendency to impact the value of the loonie. I'm sure you're aware. You know, the Canadian loonie is a commodity-based currency, crude oil being their chief export. And so whenever the U.S., being their chief consumer, puts out values, whether or not they have a surplus or a deficit, it does tend to impact the value of the loonie. Actually, if I'm not mistaken, oil prices took a pretty significant hike after the OPEC meeting last week, so you may want to look into that. For the US dollar, Canadian dollar, on the daily time frame, we're looking at a capital bearish AB boundary. Capital A is at price point 1.3793, and the capital B is at price point 1.2413. The market's retraced pretty aggressively in the direction of the bulls, and we have been tracking these retracements with sub-up ABCDs. So the most recent sub-AB boundary has actually fulfilled itself, but has not given a high true to the left, true to the right. Now, why is this important? This is important because this is also tracking that same movement that we saw from the US dollar, right? The dollar appreciated in value and kind of took out the capital A, fulfilled the de-extension, right? Or is about to fulfill a de-extension. So with a new AB boundary having been fulfilled, tentatively what we're looking at, since it's not yet satisfied with a high, true to the left, true to the right, but the next sub-up AB boundary is here. And we are seeing this market in a bit of a retracement. Now, it's not always going to be tentatively. This is the new AB boundary when it appears. Now, I did want to point out, guys, that remember when it comes to what the dollar index is doing and what the US dollar crosses are doing, you can get a pretty good expectation, right? But don't expect that it's going to be 100% guaranteed every single time, right? Every single one of these currencies will not move at the same time, nor will it move with the same intensity. So if we take a look at, if we compare what we saw with the dollar just recently, we saw that the dollar already completed its U-turn, is actually well on its way to becoming oversold. Right, well on its way to becoming oversold. The Canadian loonie, though, is just starting its U-turn and might dip down here toward the 382, the 50, the 618, what have you. So although the US dollar index is showing us that I do want to defer to the dollar index ultimately, personally. I do want to defer to the dollar index ultimately. It's what I like to do. But if I notice that as of right now, this market on this time frame hasn't given me a solid candlestick formation that I can really operate with. As a matter of fact, last week I passed on trading the dollar CAD because I was expecting the U-turn, but it never gave it to me on the US dollar Canadian. Right? So because it never gave it to me on the dollar CAD, I did not enter in trading this currency. And it still hasn't happened thus far. As far as the dollar index is indicating, it looks like the U-turn is already coming to an end and the dollar CAD remains in the same location. So that's kind of a little bit of a hiccup that we have here. You can see the overall structure reflecting more or less the same movement, but again, it doesn't mean it's going to happen every single time with every single currency perfectly, right? It's just a general indicator. So it's a damn strong one, but it's not the final word, right? You have to, if you are going to look to trade this, the way that this is typically traded is traders will trade the basket, right? So they'll trade all of the currencies together at the same time. Right? They'll enter in. They have been known to enter in at the same time. And the reason why they do that is because some of these currencies will not give you the perfect entry. And in order to make up for any lack of movement, you might have a currency that is moving super hard in anticipation to a move and will make up for a lack of volatility on another currency pair. So with the US dollar, Canadian dollar, at least from a daily standpoint, it is a little rebellious right now. It's not exactly giving the ideal signals that I would look for. I'm actually already, there's still a little bit of momentum for the US dollar index for it to continue to dip down in the bearish direction. It's not quite ready for the buy yet, but it's giving signals that the bearish momentum is slowing down. So it is something that we want to consider. Next, let's take a look at the 2-hour time frame. For the 2-hour time frame, we also have a capital bullish AB boundary. The D extension hasn't been fulfilled here, but the market has given me a higher high. So I've got to adjust the trend line to account for all of the lows before that highest high. And the next thing that I want to do is I want to account for recent consolidation. It looks like the market doesn't seem to have too much trouble reaching this as an average of resistance. And this price, the market seems to be coming down toward as an average of support. But the issue with this is that the distance between these 2 points is only about 26, 27 points, right? So even if it would have been up to 40 pips, not points, I apologize. Even if it had been up to 40 pips, I would be okay with that because that would be in line with what the dollar index shows, about 20 points in distance between support to resistance. What am I looking for? Really? I want this to line up with the US dollar. So I want the dollar CAD to start to dip along with the US dollar index. And in order for me to be able to participate with that, it's going to have to break out of this range. This range right here, and I'm actually glad for it because of the lack of convergence, the distance between these 2 points is less than 150 pips. It's less than 60 pips. So because of that, this is completely out of the realm of tradability for me. This is a no trade zone. As long as this remains inside these 2 red lines, I have zero interest whatsoever in looking to participate in any way, shape, or form with this currency. Okay, whatsoever. If this market manages to form a decision bearish candlestick formation closing beyond support, then I can consider the breakout, especially if it's lining up with the US dollar, multiple signals showing that it is also, like the US dollar, planning on depreciating, then I'll feel a lot more comfortable looking to participate. But as long as the market remains inside this, it's just not really in the realm of tradability for me. Not touching it. All right. Again, traders, just like with the dollar, you could use a pip snapper to try to identify an entry opportunity, right? This is in the sell zone at the moment and has been dipping for a while, right? Just like I expected, but without appropriate and corresponding signals with the dollar index and larger time frames as well, I am reluctant to participate. Dollar index is rapidly approaching a level of support, and I would be expecting that it's getting ready to rally. If it breaks out, then I'm going to be looking for the opportunity to be able to trade it. So we'll watch this carefully. More than likely, as long as it remains outside of convergence with the dollar index, this will remain sideways inside of that small range, and that's actually my preference. I don't like trading on shaky analysis or shaky information when I feel a lack of convergence. It's just not giving me enough information for me to feel confident looking to jump into a position. Does that make sense? Yeah, absolutely. Absolutely. And for the, yeah, that will be the only, with respect to the crude oil inventories put out by the U.S., that's the only time that you'll hear me say that, right? I generally don't encourage traders to make that jump in logic. If you're looking at a upcoming major projected impact fundamental announcement, and the announcement is for Europe, then I generally just encourage traders, if it's for the euro, trade the euro. If it's for the Aussie, trade the Aussie. The U.S. oil inventories is a U.S. announcement. Yes, it is. But When it comes to commodity-based currencies like the Canadian loonie, you've got kind of a different situation. You have to consider the repercussions of fluctuations in their chief export. So the Canadian loonie, the Australian dollar also, a lot of traders like to follow gold and then based on the direction of gold, look to place entries on the value of the Australian dollar, gold, platinum, right? They follow gold and platinum, precious metals, because Australia is pretty heavy in producing these commodities. So you, usually that is the only time that you will hear me encourage traders to also consider a different basket other than the one that's being mentioned directly. Right, that's the only time that I'll do that with crude oil inventories. Right, I try to keep things on a level where, again, like I mentioned, I've got different levels of skill in these sessions, different skill sets, different levels of comfort. So what I'm trying to do is I try to teach things in such a way that it allows you to understand where you are with respect to the market, understand the dynamics of it all, and then from that baseline, you can expand your knowledge or ask any questions that you feel comfortable with. I generally try not to bombard traders with way too much information in one shot. As I know for me personally, if I hear way too much jargon or just an information overload, my brain shuts down. And it becomes very difficult for me to retain the information. So I try to, live by the golden rule, the golden ratio, if you will, do unto others. I know I wouldn't like it and or be able to deal with it, so I try to keep it. But if you have any additional questions, of course, don't hesitate at any point to ask the question. If you get it, you get it. For those traders that don't get it, again, also, I want to encourage you as well. That's the purpose of these live sessions. If you don't get it, let me know, right? And I'm more than happy to handle that with you. All right. Any questions on this before we take our next break? Any questions on this? Okay. I'm going to save this then. Let me take a quick peek at the Euro Kiwi that I participated. This is pulling back really strongly as well. Hasn't broken the bias, but it's pulled back pretty aggressively here. These have actually given me the buy signal. Well, this one is giving me the buy signal, so I'm going to participate here in a buy for the Euro Yen. Stop loss, 30 pips away. Okay, risk 1/2 of 1%. Okay, so I'm taking that here in front of everybody. This one has not given me any kind of buy signal, so I won't be touching that. This has given me the buy signal, so I will take this buy as well. I was waiting for that. Stop loss, 30 pips. Risk of 1/2 of 1%. And for these long term, I'm waiting for these to test to give me the short opportunity. So it looks like these very soon will be giving me just that. Let's go ahead and put 145.29 roughly. So I'll put a line up at 49 and one line at 69. Okay, plus 40. There we are. So there's that. For this one, I need to label it as well or put out my lines. 127.77 is the price that I got in at. So at 97. Oh, good. And at 17. Okay, plus 40. And I'll put a line here, plus 20. All right, labels there. All right, perfect. So these are where they need to be. The Euro Kiwi is a little, but the stochastic indicator is starting to enter into the overbought zone, which I like, so that should start to come on down. The rest of these have not yet complied with the information that I was looking for from the larger time frames, and since they have not yet complied, I will not take entries with these just yet. All right, any questions on this before we take our next break? Another 15-minute break here on the horizon. Any questions on this before we go ahead and transition? All right. So with that said then, guys, let's go ahead. Let's take our next break. Going to take a short break here, 15 minutes, and then we'll be right back for the education portion when we return. This has been Will Gomez, FX Showtime. See you soon. Alrighty, everybody. Apologies for that delay. Let's go ahead. Let's continue here with our discussion. We're getting into the education portion now. So let's go ahead. Let's open up the slideshow here for today. Let me do a quick check as well of the rest of these. These are starting to look really good. The pounds. For the pound Aussie, pound CAD, we talked about waiting for a trend line test. The pound CAD especially is starting to take off in the bearish direction, crossing down beneath here. So it looks like perhaps at the conclusion of this, I might have exactly what I'm looking for in a few seconds here. I might be able to go ahead and participate with this. Actually, I'll go right ahead. It's already setting up, so I'll go ahead and stop loss. This is going to be 30 pips. Risk percentage, 1/2 of 1%. All right, so I've had my trend line test significantly enough above the nearest level of resistance. That's okay. And I'm going to put entry price 1.7596. So down here to 76. And one more at 56. With the alarm. Plus 20 pips here for this one. And plus 40. There we are. Pound yen. That's pulled back a little bit there. The Euro Q is also doing some funny business that stop losses, as I feared, is a little bit too close. For these, still waiting for the trend line test. These are actually changing bias here. So that's a bit of a worry. These are testing the line. So if I can get a bearish candlestick formation next here for this, I'll go ahead and I'll look to participate. Okay. So with that taken care of, let's go ahead, let's move in to the actual discussion here for today. Last week, we spent a considerable amount of time talking about Fibonacci's, identifying trend direction, how to appropriately trade. What I'd like to discuss today is a little bit more on reversals, okay? We discussed how to go about effectively identifying entry while everything is functioning the way that it should, right? When we're looking at a trend developing, a Fibonacci developing, we understand, right, that the market's doing what it should be doing. It's moving in the direction of the trend. Everything is participating, or we're participating, capturing profit as, business as usual. But what we need to learn also how to deal with is how to tackle a market reversal. Usually this kind of thing tends to make traders really nervous, right? Market reversals tend to make traders really nervous. So let's kind of try and dust off some of the cobwebs, or at the very least, kind of banish some of the fears that we might have whenever the market changes direction. We've explored how to interpret trend direction and how to track normal trend direction. But the market's not always going to move in the same direction. Here we have plenty of examples of just that. The market was for some time making higher highs, higher lows. As a matter of fact, this is a daily chart, so you can see how many months transpired while the market was going in a particular direction. Same thing for when the market decided to reverse and go in the opposite direction. And again, and again, and again. All right? We're not going to fear this. We just need to learn what the patterns are to be able to deal with it and tackle them as they present themselves. So the two patterns that exist are, two patterns that we're going to talk about, I should say, are the head and shoulders pattern, and the other one is the crown pattern, crown reversal. As far as what I personally prefer, I'll go ahead and, full disclosure, I'll tell you right now, my personal preference is for the crown reversal pattern. The reason why I prefer the crown reversal pattern is because in the crown, you are required to have that much more confirmation, right? Which we're going to talk about in a minute. The crown requires more confirmation, and it sets up for entry after confirmation. Whereas, in my opinion, the head and shoulders pattern more so kind of shows you just kind of have to trust it and hope that it'll work. All right, so that's the issue that I'm running across when taking a look at the head and shoulders. It's not that it's not a viable pattern. It's a little bit more fickle, and it doesn't call for as much confirmation. That's my personal issue with it. All right, so make sure that you're learning to deal with these reversals. Let's quickly recap, though, what we talked about last week. The first thing that we talked about is when drawing the ABCDs, we know that once we have the AB boundary, the next task is to identify the C, and based on the C, we project a D extension. Now, as long as that AB boundary is in place, right, we know that the C retracement is going to be the nearest point to the A after the B. There are only going to be two reasons why that AB boundary would change. Once we have an AB boundary in place, there's only two reasons why the AB boundary will change. The first one is if this D extension actually gets satisfied. If the D extension full ABCD kind of plays out, then we know that C is going to become a brand new A, D is going to become a brand new B, and we've got a brand new AB boundary to deal with. All right? The market should once again retrace to give us a new C and eventually extend toward its new D extension. The other reason why the AB boundary might change is if the market C takes out the A. So if I have my AB boundary and the market ends up going down lower than the capital A or higher than the capital A in the case of a downtrend, right? If the market ends up doing something like this, then we have to recognize that the AB boundary has been taken out and we have to reverse. This time we're going to reverse plotting our Fibonacci ABCDs in the opposite direction. So following the ABCD rules, which I'm sharing in the box right now, and I'm also going to share the 5 steps for that crown reversal pattern. All right, let me just find that right now. Sharing that with you right now in the box. So when it comes to an AB boundary being taken out, you reverse. In this case, it went from an uptrend to a downtrend. So we start at the highest high to the first low, and we're tracking the market reversal now in the new ABCD direction. When it comes to these patterns, right, head and shoulders and the crown reversal patterns are effectively ABCD patterns, right? No matter what they look like, they still are ABCDs. They're just an ABCD going one direction followed by an ABCD in the opposite direction. Since that's the case, they have to conform to the ABCD rules, which I've shared with you all in the box. You should see my name. Right next to it, it'll say ABCD rules. And if you click where it says click here, it will take you to this. Right? These are the ABCD rules which you can follow. Whether you're in an uptrend or a downtrend, I've got you covered. You've got clear, concise rules that you can follow. Make sense? Any questions on this? No matter what AB boundary you're looking to draw, be it a reversal, be it a normal AB boundary, be it a sub-ABCD retracement, or as some traders will refer to it, Gartley's, These are the rules that it has to conform to. So if that's the case, then we just have to observe that, and it helps us to perish our fears. If we have an A, B, C, D in one direction, and then that A, B, C, D completes itself, that means that C is going to become A, D is going to become B, and we've got a brand new A, B boundary. However, if that market ends up coming down to take out the previous established A, then we know we would reverse, right? And we will go from, in this case, the highest high to the first low. What should happen next is the market should retrace to give us a C and then extend to create its new D extension. This is what gives you that crown pattern, or the head and shoulders. All right? Any questions on this? Is everybody seeing this and on a conceptual level? Is everybody understanding this on a conceptual level? Any questions on this so far? Okay. So let's move on then. What I have done also in the box, you should see there's also a section that says 5 steps to crown reversal next to my name, and it will also say click here. If you click on that, you're going to get another write-up like the ABCD rules that I showed you. Right? This write-up right here contains the 5 steps to the crown reversal. Right? So I've shared that with you in the chat box. Please feel free to download that at your leisure, completely up to you. And what we're looking at here are all the steps that the market will follow, must follow, in order for you to have what's known as a reversal pattern, a crown reversal pattern. So before you get too worried about this or worry about whether or not your success at trading is going to depend on this, please realize that this is not a necessary aspect of trading. Okay, learning to be able to plot and or trade the crown pattern is not a necessary aspect of trading. What understanding this pattern does is help you to be able to predict, if you will, to an extent when the market is changing direction, and better yet, to be able to participate if the market starts a change in direction. All right, and the 5 steps are as follows. The first thing is the market is going to take out or break the trend line. The very first thing that the market does when it's going to change direction is to break a trend line. So if that's the case, we want to make sure that we are observing this as we go along. Okay, the very first thing that the market does when it wants to change direction, and that's exactly what the crown pattern recognizes when the market is changing direction. Very first thing that the market does is it breaks the trend line. The next thing that it should do is it should take out the A. So if it takes out the A, that means that the market is exceeding the current capital AB boundary, which, sorry about that, I got a random message in Thai. Since that's the case, we want to recognize anyway, if we were just plotting A, B, C, D, so if you pretended that you'd never heard anything about the head and shoulders or the crown reversal pattern, if you'd never heard anything about this, you would naturally look to reverse anyway, just like we discussed before. So when the market takes out the A, you know that all you're going to be doing is reversing your drawing pattern. The next step for the crown pattern or head and shoulders pattern is that you're going to identify the left tip. And we're going to explore this in more detail next, but you're going to identify the left tip by identifying the previous B of the previous AB boundary. And then once you have that, you're expecting that the market should form the right tip at approximately that same price to the right side of your trend line. So step number 4 is going to require you to identify where that right tip is, and once you identify it, look to enter in the opposite direction. The 5th step, which I don't really draw too much attention to because you have to understand trend lines in order to be able to handle this, the 5th step is going to be to draw the new trend line. So that is that's something that you can, of course, if you have any questions on trend lines, feel free to indicate that in the box. So let's explore this. All right, 5 steps in action are as follows. Here are the 5 steps, and we're going to track these one by one. So if we've got an A, B, C, D trend, and I usually use an uptrend because it tends to be a little easier for traders to understand conceptually. If any trader would like a downtrend example, then don't hesitate. Just email me directly, all right, and we can work on that, making sure that you understand in either direction. But in any case, it has to follow the same rules. So if we have an A, B, C, D trend in the direction of the bulls, to keep this nice and light, nice and easy, what I have here is the market coming to the trend line every single time. This green line is my uptrend line, and the market's been making A, B, C, Ds, A, B, C, Ds in the direction of the trend. Okay? Now, with that established, we know, right? We know better. We know that the market isn't always going to come and test the trend line every single time, right? Instead, the market may bounce at a earlier level of Fibonacci, or the volatility may increase. Whatever the case may be, a fundamental announcement might be read, and the market may aggressively take off, right? So that is an option, but for the purposes of this lesson, I want to keep it nice and clear. So we have the first A, B, C, D gets fulfilled. So C became A, D became B. The next A, B, C, D, after it created that new A, B boundary, the market retraced and then extended to its D extension after time. So that means the next A, B, C, D was completed as well. With a secondary A, B, C, D completed, then we now know that we've got another A, B boundary on the way. And since the market so far has been fulfilling these, we know to expect that the market should retrace and either bounce at the trend line or at one of the Fibonacci levels. Instead, what it does is it busts right through the trend line. That's step number 1. Right? Now, just because the market has taken out the trend line does not mean that we're immediately going to panic. Instead, we have to accept that there are other Fibonacci levels that the market could bounce off of. Remember, the Fibonacci tool is going to be drawn from A to B. So the market could realistically bounce at any one of those other Fibonacci levels. Now, if the market instead continues further and exceeds where the AB boundary, or where the A boundary is, this is step number 2 of being fulfilled. Once step number 2 gets satisfied, we can pretty much say that without the shadow of a doubt, the market's getting ready to reverse. Right? The market's getting ready to reverse. So because the market is about to reverse, we go ahead and we move on to step number 3. Step number 3 calls for us to identify the left tip, right? And the left tip has to be the previous completed AB boundaries B, right? So it cannot be this point right here for 2 reasons. Number 1, the center tip of the crown, right? We know what the crown shape looks like. So the center tip of the crown always has to be the most prominent point, right? It has to be the most prominent point. And based on the information that we can see right here, that is the most prominent point, the highest point, or the lowest point in the case of a downtrend reversal. So if that's going to be the case, then we are not going to say that this is our left tip. Instead, it has to be the B of a previous completed AB boundary. And this AB boundary has been taken out. So because this AB boundary has failed, we also can't use this as our left tip. All right, any questions on that? Okay, so we're looking for the previous completed A, B, C, D. That previous B, that's going to be our left tip. And we're going to try and identify that price, and the reason, as I mentioned before, is we're expecting that the market's going to give us the opportunity somewhere around that same price over here. So if that's the case, the next step is we're going to start to draw our new AB boundaries. For step number 4, we draw our new AB boundary. In this case, we're going from the highest high to the first low. There's our new AB boundary. Once we have the new AB boundary, what do we do when we have an AB boundary? We look for C and we try to get in at C to take the ride to D, right? We're looking for a candlestick formation based on what we discussed last week that agrees with this ABCD movement. So once we've identified that ABCD, we can then go and look to enter in. Once the market retraces and gives us that C, we can look to participate entering in at C. Once the market goes ahead and satisfies that new A, B, C, D, we have the crown shape, right? That's the crown. That's all the crown is. It's just an A, B, C, D in one direction, followed by an A, B, C, D in another direction. The fifth step calls for us to draw the new trend line. But this is our crown. Our left tip, center tip, and right tip. So here is an actual charting example so you can get used to seeing this, all right? This is an actual chart example. We have the market. It was making higher highs and higher lows. Here's my trend line, an inner trend line. And we had the A, the B, the market retraced to give us a C, bounced off the trend line, went to a higher high based on this really deep C retracement, went to a higher high, fulfilled the D extension target. So what happens next? C became A, D became B. Next, C retracement, nearest point to the A after the B, and then the market fulfilled the D extension target 1.618. So what should the market do next? Well, it should give me a new A-B boundary, right? There's my A, there's my B. And what I'm looking for is for the market to retrace, touch the trend line or one of my Fibonacci levels, and bounce off of that to go to its next D extension. What did the market do instead? Well, step one, it broke the trend line. Step two, it took out my capital A. You see how this price point was lower? So it took out my capital A. So because of that, I now understand that a reversal is more than likely taking place. So I go ahead and I move on to step number 3. Identify the B of the previous completed A, B, C, D. I identify that B, and once I identify that B, I put a line because I'm expecting that the entry opportunity is going to form somewhere around that price point at the backside of the trend line. Then I move into action. The ability or the possibility of being able to trade the new reversal that's taken place here. So I'll draw my new AB boundary, highest high to the first low. The next step is to look to identify my entry. So I'm going to be looking for the market to give me some sort of entry opportunity somewhere around this price point at the backside of the trend line. Take a look at what the market forms right around that same price at the backside of the trend line. Beautiful bearish decision candlestick formation. If you know anything about counter trend lines, you'll notice there's an aggressive counter trend line in the direction of the bears. You'll know there's an aggressive counter trend line being broken by that candle and the beautiful subsequent fall after that. That is my A, B, C participation point, and then once that D extension target is fulfilled, I have my crown. So step number 5 would have called for me to draw my new down trend line, which allows me to be able to track the continuing trend. The market should continue to behave based off of that trend line. That is the king's crown, or the head and shoulders, right? Now the king's crown, head and shoulders pattern, I prefer personally the king's crown over the head and shoulders. As I mentioned, the king's crown requires for us to have this retest of the backside of the trend line, and then the candlestick formation that lets us know we've got a solid entry. The head and shoulders pattern calls for us to enter over here at the break of the neckline, which means you're entering in expecting that the market's going to be pulling against you and hoping that it will bounce off the backside of the trend line to continue. So for me, that's just a little bit too hopeful. That's a little bit too optimistic. I prefer when the market tries to come back and gives me confirmation of the rejection for entry. That just is a better fit for me. Also, with the head and shoulders does not require, the king's crown does not require symmetry. So in a situation like this, I can have a higher left tip and a lower right tip. I can have a higher right tip and a lower left tip. I can have no right tip at all in the event of a fundamental announcement, right? I can have no right tip at all. But if I'm dealing with the head and shoulders pattern, if the right tip is higher than the left tip, it immediately invalidates the formation and you have to abandon it right then and there. Okay? So there are many, many reasons why I prefer the crown reversal pattern to the head and shoulders. I hope that this has helped clarify things for you, seeing it both graphically and on an actual chart. You have been provided with the directions, but If for whatever reason you should require any additional explanation on this, I want you to feel very, very comfortable. Please let me know. Right? It will be my pleasure to work with you on this and make sure that you understand this pattern if it is something that you are interested in using in the future. All right? So that's going to bring us to the conclusion of this discussion, guys. As always, thank you very much for your attention and your questions with respect to that. Let's do a quick check. We'll wrap up with a quick check of the entries here. It looks like I am seeing some progress here for the pound CAD in the bearish direction. We are moving nicely in the direction of the bears. Pound Aussie has opted to go a little sideways here. And since I don't have a bearish decision candlestick formation beneath both of the lines, right? I'm between the biases at this point. I have opted not to enter into any position here with the pound Aussie. So I'm still waiting patiently for that. The Euro Aussie came, it not only tested the trend line, but also broke above it. So this is a total change in bias, but it looks like it's coming back into, going to be reversing back in. The Euro CAD also changed the bias, but seems to be just falling right through. So if this comes right back into the bias in the direction of the bears, then I will consider again, as I mentioned, I'm waiting for the entry here for this. This hasn't provided me with the entry for this just yet, so I'm having to wait patiently for an appropriate entry to present itself. The pound Kiwi also has not given me the opportunity. It looks like I've taken a hit here, a 0.5% hit as far as the Euro Kiwi is concerned. It pulled back, but it pulled back too aggressively, higher than my previous level of resistance even. So my stop loss was simply not able to deal with that, and this has ended up taking out my position. Only now has the market actually formed a candlestick formation that's beyond the bias, right? Decisively beyond the bias. That is the same candlestick formation that ended up just being too high for my stop loss to handle. So I have taken a very small risk here, a small hit here. It is what it is. If the market provides me with another entry opportunity, I will look to try and participate with it a little later on. But unfortunately, this has not worked out in my favor. All right. Any questions on what we've looked at here so far? Any questions on this? Okay. So with that said, guys, as always, I want to thank you very, very much for joining me with this discussion. It's always a privilege, always a pleasure. Please feel free to contact me with any questions that you may have in addition to what we've discussed right here. Of course, I want to handle that with you. Any questions, comments, concerns, feedback, as always, my door is always open to you. Don't hesitate to email me, will@perpetualpip.com, perpetualpip@gmail.com. I am at your service. I'll see you all tomorrow for the next broadcast. We're going to be back together again, same time, same place, 2:30 a.m. Eastern time. So for the short time that stands between us from now until then, stay thirsty for knowledge, my friends. This has been Will Gomez, FX Showtime. Have a great one.